2025 has been another incredible year for the market. The S&P 500 is up nearly 17%, and in reality, the past 2 decades have been phenomenal for the market. And every year, near the end of December, Barron's releases their top 10 stocks to buy for 2026. So in this video, we're going to be analyzing their top 10 picks, and actually a few of them tend to be high-yielding stocks. So let's go ahead and jump into it. Now, historically speaking, Barron's has had years where they've certainly underperformed the market, but 2025 was very good for their picks. Their stocks averaged a nearly 28% return, including dividends, outperforming the S&P 500's 16 to 17%. Let's do a quick review of their top 10 stocks for 2025. You can see we have Alibaba, Alphabet, which is Google, ASML Holding, Berkshire Hathaway, Citigroup, Everest Group, Louis Vuitton, Moderna, SLB, and Uber Technologies. And while they certainly had a few picks way underperform the market, with Moderna falling 32.2%, Everest Group falling over 10%, their big winners more than made up for this. Now, when I looked at this list, here's a few things that didn't surprise me. 2 stocks I was incredibly bullish on for the majority of the past year. I covered Google extensively, and even made a video stating how it looked like the best opportunity on the market about 9 months ago. And then ASML was a stock I actually added to my portfolio and have done very well with. I'm currently up around 57.62%. after just adding it earlier this year. So I definitely agreed with those picks, but Alibaba was a stock that I was surprised to see do as well as it did. From a fundamental standpoint, it was absolutely undervalued, but there was a lot of fear from investors due to the fact it was a Chinese stock. On top of this, Citigroup did very well, as most financials and especially bank stocks did really well. Think about stocks like JP Morgan and Bank of America. These stocks did very, very well in 2025, but Citigroup was definitely one of the top performers. But they did all outperform the market. And then Uber Technologies was a big winner as well. So overall, a very good year for their 2025 picks. Now let's start breaking down their 2026 picks. And their first pick was none other than Amazon stock. Now I'll plug in this stock ticker and you can see all this data is going to automatically load into my spreadsheet. And like always, if you'd like to be able to download any of the spreadsheets that you see used throughout my videos and get access to the ticker data add-on that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description, where you can get 30% off the annual plans. Just use code 2026 at checkout. Now, what we can see about Amazon is over the past 5 years, they've grown EPS at a substantial rate, 37% EPS CAGR. But if we look at them in the last year, they've trailed the market by a wide margin. In the last year, only up by 2.83%. So let's look at Barron's reasoning for having them on this list in 2026. To start, they said Meta stock surged in 2023, Nvidia soared in 2024, and this year belonged to Alphabet. It could be Amazon's turn among the Mag 7 in 2026. And they are absolutely right. When we compare them to the Mag 7 stocks, they've way underperformed. Google was up around 63%, Nvidia significantly, Tesla significantly. Even Apple was only up by about 8.65%, but that still doubles the performance of Amazon in 2025. Now, one of the points that Barron's makes is that they're actually trading at a discount to the slower growing Walmart. If we look at Amazon, their forward PE is sitting at about 32.13. Meanwhile, if we just glance at where Walmart stock is sitting, they're sitting at a forward PE of 43.36. So despite slower projected earnings growth from Walmart, they're still trading at a higher PE multiple. Now, with that being said, strictly comparing Amazon to Walmart is obviously not a fair comparison. There are similarities, but Amazon is much more diversified. They own a multitude of brands, whether it's devices and services, retail, e-commerce, media and entertainment, proprietary brands, logistics, technology, and cloud computing. Now, if we look at Amazon's PE multiple over the last 5 years, you can see it's pretty much trading at its lowest valuation during that time duration. Now, you could absolutely argue that this isn't the best way to analyze Amazon stock, and in reality, the future depends on one thing. How will their heavy capex spending pay off? And really, this is true for a lot of AI, tech, and Mag 7 stocks. Capital expenditures from 2024 to 2025 nearly doubled, and it's projected to continue to ramp up moving forward. But with that being said, Wall Street remains incredibly bullish on this stock. The average analyst price target is $296, giving them about 30% upside. Now, the second stock on Barron's list is Bristol Myers Squibb. I think this is one that surprised a lot of people because it's a pharmaceutical stock, and they're claiming it could be the industry's turnaround story for 2026. So let's take a look at BMY. We'll plug in the ticker and drag down these formulas And you can quickly see why it's surprising this stock was on the list. The EPS growth has not been pretty to say the least. Negative returns year to date and over the last 3 years. But with that being said, the starting yield is now sitting at about 4.54%. So what's been going on with BMY? Again, in the last year, down by about 3%. So let's go ahead and jump over to our stock screener and take a closer look at the fundamentals. And what we see starts to tell a story. Revenue per share for this company has essentially been growing every single year. Now, it certainly hasn't been fast, but the same is not true with EPS. EPS went negative in 2024 after a few years of being in the $3 to $4 range. Now, there's a multitude of reasons as to why this is, but to start off, look at the gross profit ratio for this stock over the last decade. It has declined significantly, and even in the last 3 to 4 years has declined as well. Now, why is this the case? Well, we have to remember what type of company we're looking at. We're looking at a pharmaceutical stock. That's really important to understand when it comes to how the stock is being valued right now. But as it relates to the gross profit ratio, they saw margins decline significantly in 2024 after they booked major charges related to some research and development firms that they had acquired. So you might be thinking, okay, that means this might not be something to be too concerned about. Well, here's the big concern a lot of people have for this stock. Like we just saw a moment ago, their 4-year average PE multiple is only about 11.11. And if we look at this company right now, their forward PE multiple is just 8.29. So they look quite cheap compared to how they've historically traded. But what do we need to know about pharmaceutical stocks? Pharmaceutical stocks are always trading based on what the future growth of their pipeline looks like. These companies have to heavily reinvest into research and development to continue to create new drugs to drive future growth. And for a long time, the largest driver of growth for BMY was their Keytruda patent. But unfortunately for them, that patent is set to expire at the end of 2026. And to show just how detrimental this is, look at what their projected earnings growth looks like after 2026. Negative 8%, negative 2%, negative 6%, negative 7%. So we're talking about a stock that is projected to start declining in earnings after the end of 2026. So typically when we look at stocks and look at their valuation, we're thinking about how they're going to grow earnings in the future and looking at how they're trading compared to how that growth will look like. But how do you value a stock that has negative earnings growth projected over the next 5 years? It starts to become much more difficult. But if we look at the argument that Barron's makes, they say they trade for just 8 times projected 2026 earnings, giving it the lowest PE multiple in the drug sector along with Pfizer. It carries a safe dividend yield of 4.9%. So essentially, they're claiming the stock is cheap at its current prices. On top of this, they noted that the CEO stated that he feels even better about the outlook given a sell shift away from drugs with patent expirations. The other argument they make is at their size, they could be a target for a buyout. So in my opinion, this is a very aggressive pick from Barron's. The business quality is not very high. And anytime you're having to hope for a potential buyout for an investment to become profitable, that's probably an area I don't want to be investing in. That's certainly not to say that BMY can't turn things around, but it certainly depends on what their future product pipeline looks like. At number 3, we have Comcast. Barron's believes in Comcast because it's one of the cheapest stocks in the S&P 500 based on projected 2026 earnings. So let's take a look at Comcast. Let's see what type of opportunity they present. Off the bat, we can see they've grown their 5-year EPS CAGR at a reasonable rate, close to around 8%, and their PE multiple is significantly discounted compared to the 4-year average. So again, it looks like they're looking for a deep value play. And on top of this, even though the returns have been pretty bad year to date and over the last 3 years, the dividend metrics actually look quite attractive. Let's go ahead and jump over and take a closer look at those dividend metrics on the dividend breakdown sheet. Take a closer look at Comcast. We can see that starting yield is now sitting around 4.4% combined with a 5-year dividend CAGR of around 7.6%. So that's actually a pretty impressive combination of yield and dividend growth. Now, if we look at the yearly dividends charted out, it's not a true representation of dividend growth because of the timing of some of those year-end dividend payouts. But if we look at the dividend history on a quarterly basis, you can see essentially every single year they are growing those quarterly dividend payouts. So from a dividend growth perspective, it's pretty easy to like what you see. Now, what's interesting about this is the free cash flow payout ratio has remained relatively low at 31%. Earnings payout ratio just around 30%. So despite the stock selling off significantly, that dividend still looks very sustainable. Now the question is, what will dividend growth for this stock actually look like moving forward? Because for reference, if we look at earnings estimates, we can see they're quite low, especially in the next couple of years. It's pretty much projected to go nowhere, and we have to remember dividends are paid out of free cash flow. So if free cash flow is not growing in the future, then dividend growth is not sustainable in the future. Now again, because the free cash flow payout ratio is so low right now, they could grow dividends in the short term without seeing an increase in free cash flow, but it means the payout ratio would be increasing, which over the long term, again, is not sustainable. Now, one of the things that they point out about Comcast is they now trade below where they did a decade ago. Because Comcast's cable and broadband business, the largest in the country, has been shrinking slowly. And like we just pointed out, next year's earnings are actually expected to fall. Comcast recently lost out on the bidding war for Warner Bros. Discovery, but could still separate its valuable media, entertainment, and parks businesses, which could create $30 billion of value or $8 per share, argues Wolf Research's Peter Supino. So again, the argument here is that this company is in deep value territory. A potential spinoff could make sense. And that could absolutely be the case. But again, I prefer to rely on not having to have that type of situation play out. It's a bit optimistic. But it is a situation that could play out quite well for the stock. And one of the reasons for that is because this is actually a very CapEx heavy stock. For example, let's go ahead and look at Comcast and say that we want to look at CapEx to revenue. Comcast has to continually invest in its physical network, like cable and fiber upgrades, network maintenance, and reliability. So CapEx to revenue is often a little bit above that 10% range. Now, the potential benefit based on a spinoff situation is this does mean that they've been building out assets that have value on the balance sheet, which is one of the reasons that Barron seems to think that there could be potential with a spinoff. At number 4 on Barron's list, we have ExxonMobil, an oil stock. If we plug in ExxonMobil, let's go ahead and get the highlights. What we can see is so far on this list, this is one of the few companies that has actually seen decent returns year to date. And again, this is another stock on this list that has an above average starting dividend yield, especially compared to the S&P 500. In the last year, ExxonMobil's up by about 11%, and year to date up by about 10%. And if we go ahead and look at them from a dividend perspective, again, one of the things you'll see is that dividend growth has been very slow. The 5-year dividend CAGR is sitting at just 2.82%. So again, despite the above average starting yield, the dividend growth history is really not that impressive. Now, there's a multitude of reasons for this, and really the main being this is an oil stock. Why is that significant? Again, sectors oil, industry, integrated oil, and gas. Well, one of the things we have to understand about a lot of oil stocks is they're very reliant on, believe it or not, oil prices. And oil prices can be very, very volatile. For example, we can see where it was basically at the bottom in 2020, and then it essentially 6x'd through 2022, so just a 2-year time period, and then it's more than halved since then, and has continued to decline in the last year. Now, this is important to understand because of what it does to the company's free cash flow margin. So let's look at ExxonMobil. And let's zoom in and take a closer look at this. Again, here's the key column we want to pay attention to. Free cash flow margin, what is this telling us? Well, it's essentially telling us for every $100 in revenue that the company generates, how much is actually converting to free cash flow. So for example, in 2014, a free cash flow margin of around 3%, $100 of revenue equated to $3 in free cash flow. And remember, free cash flow is the capital the business could use to do things like reinvest back into the business, buy back shares, or pay out dividends. So it's very important. If free cash flow is growing, intrinsic value is growing. And what we can see in 2021, 2022, when oil prices skyrocketed, and what we can see in 2021 and 2022, free cash flow margins were the highest. And it's no secret that that's also when oil prices went the highest. There is a direct correlation. But as we saw oil prices go lower, free cash flow margins started to decline. And in fact, in 2020, when oil prices went so low, their free cash flow margin even went negative. So I hate to sound pessimistic, but when it comes to these types of oil stocks, you're so heavily reliant on commodity prices that it makes me a bit nervous to invest in these types of companies. With that being said, there are some pretty phenomenal high yield stocks in the oil sector that aren't as reliant on commodity prices. This was something I was talking about over on Dividendology.com not too long ago. We're building out a real money high yield portfolio, and we recently added a stock yielding over 8%, growing its dividends at a double-digit rate that's not reliant on commodity prices. So if you want access to my most in-depth research and want to be a part of building out the real money portfolios, be sure to join at the link in the description, or you can simply scan the QR code that I'm putting on the screen right now. Now, if we look at what Barron's highlights, they state they have a 5-year corporate plan that was highlighted by ExxonMobil. Exxon now sees 13% plus compounded annual growth in earnings per share through the year 2030, up from the prior target of about 10%. But this assumes Brent crude averages $65 a barrel in real terms. So again, very reliant on oil prices. And then at number 5 for Barron's, we have Fairfax Financial Holdings. And it's very likely you haven't heard of this company, but they claim it could be the closest thing to a mini Berkshire Hathaway, and it may be even a better bet at this point. The company is a Toronto-based property and casualty insurer and has strong insurance operations, an excellent investment record, and phenomenal long-term performance under founder and chairman Prem Watsa. Now again, it's important you understand how insurance stocks make money. Insurance companies generate revenue by collecting premiums up front, investing the float, and paying out less in claims and expenses than they earn from the premiums plus their investment returns. So essentially, they invest the difference. This is what made Warren Buffett so successful. The company targets 15% annual growth in book value against what's probably high single-digit growth at Berkshire. Now, Berkshire's obviously been growing slower over the past decade due to the law of large numbers, but Fairfax Financial Holdings is only sitting at a market value of about $40 billion, which makes it much easier to grow versus Berkshire Hathaway's $1.1 trillion. So the argument is like investing in Berkshire in 1993. That's a big claim to make. The company has a portfolio of Indian investments, such as a controlling stake in the Bangalore airport. Now we can see they've compounded earnings at a high rate, about 18.4% over the last 5 years, and the year-to-date and 3-year returns are simply phenomenal. If we look at the last 5 years, the stock is up 463%, and this is also a dividend growth stock, as we just saw. While the starting dividend yield is low, they do grow the dividend at a healthy rate year over year. So if you truly have any interest in investing in this company, it's going to take a lot of research, understanding the different types of opportunities they're looking to invest into. These types of holding companies require a significant amount of research if you truly want to understand what you're buying. But with that being said, there's a few analyst price targets. There's not many, there's 6, but the average price target gives them about 12% upside over the next year. Next on Barron's list, we had Flutter Entertainment, and this company is the global leader in online sports betting, but its stock at around $215 is down by a third since August's peak amid concerns that Kalshi and Polymarket will undermine FanDuel, which is Flutter's most valuable asset. Now, if we go ahead and look at this stock, what we can see is in the last year, it's now down by about 14%, and year-to-date down about 13%. And if we look at the last 5 years, returns have been pretty poor, only up by about 13%. Now, as we know, online sports betting has been exploding in popularity in the last couple of years. But competition is ramping up, and that's the concern. Kalshi and Polymarket are huge competitors. But most Wall Street analysts think prediction markets don't threaten the business model of FanDuel, who currently has 40% plus market share. The bull case is that FanDuel could easily capitalize on this trend with a 50-50 prediction markets joint venture with a financial exchange leader such as CME Group that rolls out by year end. Now, strictly from a valuation perspective, the company hasn't been publicly trading for long, so it's difficult to understand how the market wants to value this stock moving forward, but they are trading at a lower valuation than they were over the past few years. And with that being said, earnings are expected to grow at a dramatic rate moving forward. It was sitting at $7.27 at the end of 2024, and that number is expected to triple by the year 2029. So just scroll down and look at the growth rates that are projected. We're talking about 26, 46, 30, 23% growth. And because of this, most Wall Street analysts seem to be quite bullish on this stock, giving it about 32% upside with a price target of $295 per share. Pick number 7 was truly one of the most surprising on this list. It was Madison Square Garden Sports. So, sports investing is hotter than ever with record prices being paid for professional teams. The combined value of Knicks and Rangers is probably over $13 billion. The NBA's Los Angeles Lakers were sold in 2025 at a valuation of about $10 billion, and the Knicks are worth probably at least that. At least that's the argument that Barron's is making. MSG Sports, whose shares trade around $225 per share, is valued at $5.4 billion. Now, if we look at this company, in the last 5 years, they're only up by about 43.73%, and they don't pay a dividend, so returns have certainly been suboptimal. Now, the company generates revenue in a few different primary ways, but they have ticket sales and premium seating, they have corporate sponsorships, suite licenses, and media right fees. And then, of course, merchandise, food, and beverage at events. So this company is essentially an event center stock. Now, anytime we're looking at a company that you may not have analyzed much in the past, you immediately want to start thinking about what are the potential key risks. Every company has risks. We need to be able to analyze how big the threat is. So with an event center like MSGS, Madison Square Garden Sports, obviously revenue, profitability is heavily tied to things like the playoff appearances of their teams. Now, for example, the Knicks have had a few good past seasons. They've made the playoffs, made decent runs. That's good for the profitability of the arena. It also helps with attendance and fan engagement throughout the season. On the flip side of that, the risk is if the team starts doing poorly, attendance and fan engagement will probably drop. And at some point, that's certainly bound to happen. On top of this, the media landscape is changing dramatically. It already has over the last 5 to 10 years, and that will continue to happen, which makes revenue from local TV deals more unpredictable. And Barron's is really going against the grain here. For example, look at projected revenues from Madison Square Garden Sports Corporation over the next few years. It had already been stagnant over the last 3 years, and it's still not really projected to go anywhere moving forward. Very little top-line growth, which of course makes it difficult to drive bottom-line growth, earnings growth, free cash flow growth. While the stock doesn't get much analyst coverage, they're not projecting any upside moving forward over the next year. Now, the reason the stock trades so cheaply is because the CEO has ruled out a sale of the company, which is controlled by his family. But one potential way to create shareholder value would be to spin off one of the teams into a separate company or sell a partial stake in one or both of the teams to private investors and use the proceeds to repurchase stock. So again, it appears they're being a bit optimistic with a deep value play here. Their 8th pick is again New York related, and this time we're looking at a real estate investment trust. And before we actually even look at the pick, you have to understand the REIT market is particularly interesting right now, as I've been pointing out for a while now, especially over on dividendology.com, where I just wrote an in-depth report on REITs and some of the best opportunities in the REIT market. But what we have to understand is REITs are trading at some of their most discounted prices in decades right now. If we look at the US real estate versus US equities earnings multiple spread, there is a wide variance. Historically, REITs have traded at a slight discount to other equities at about negative 0.6x, but right now they're trading at a negative 7.7x discount. Now, historically, when they've traded at this much of a discount, they've outperformed US equities over the next 1, 2, and 3 years. So I'm not surprised to see a REIT on their list of picks. And their pick was none other than SLG, SL Green Realty Corporation. And what's so interesting about this is a high yield pick. The starting dividend yield is quite high. In fact, if we look right now, it's sitting very, very close to 7%. But on top of this, short interest is high at about 10%. There is a lot of institutional betting against this stock. Not typically something that I want to see. And in the last year, it's now down about 33%, and year to date down 33.54%. And we need to make note that this is an office REIT. Now, there's a few reasons for the sell-off, but one of the reasons is the weaker than expected guidance for 2026 made recently, as well as ample leverage. But also the political climate in New York City is changing. You probably already know that. But at their recent investor day, the company highlighted the disconnect between its stock price and asset value, which puts it at more than $70 per share. The CEO claimed that the company is priced at no more than the value of the land underneath its buildings. So again, they're talking about this pick being a deep value play. But why do people buy REITs, especially high-yielding REITs? They buy it for the dividend. That's no secret. So the real question is, what's the ability of these properties to actually pay out dividends? And what's interesting is if we look at the projected adjusted FFO per share. Now, again, that's what dividends are paid out of for REITs, and it's projected to decline substantially in the coming years. So what's interesting is if we simply look at this stock from a dividend discount model perspective, jump over to our valuation sheet, we plugged in SLG, and jump over to our dividend discount model. Let's go ahead and zoom in, and what we can see is if we assume 0% dividend growth moving forward, the stock is worth about $36.35 per share, which would be discounted about 19%. So if we bump it up to 1%, it starts getting closer to that current share price, and at 2%, a little bit closer, so maybe around 1.5%, we can see that's essentially what the market is pricing into this stock. 1.5% dividend growth. Now, the question is whether or not that's sustainable. So if we just look at the dividend safety for this stock and scroll down, we can see the forward-looking AFFO payout ratio is sitting at 103.9%. That's a red flag. They're paying out more in dividends than the company is generating in adjusted funds from operations per share. And on top of this, AFFO per share really isn't projected to go anywhere moving forward. So for me personally, if I was someone looking at this REIT from a valuation perspective, from a dividend sustainability perspective, this would be a high-risk company. And it's evident that institutions feel this way as well because short interest is heavy at 10%. So this is another very aggressive pick from Barron's. Barron's ninth pick is one of my favorite on this list. We have Visa. Visa underperformed the market in 2025, despite the fact it had about 11.43% year-to-date gain, closer to around 12% when you include dividends. So performance wasn't too far off from the S&P 500. But there's still a multitude of fears that caused volatility in 2025, like stablecoins, buy now, pay later, pushback on fees. Concerns about these issues and more have made Visa stock lag the market in 2025. Now, at the time of this article, Visa was only up by about 5%, but like we just saw, closer to around 12% as of right now. But Visa is a stock that has historically grown earnings at a high rate. They've grown the dividend at a high rate, and it's projected that that will continue to be the case. When this data loads in, you can see their 5-year EPS CAGR is sitting close to 13%, 5-year dividend CAGR of around 15.4%, and incredible return on invested capital of around 28.65%. Visa has high-quality characteristics that make it very attractive. Again, thanks to ticker data, the data loads in. But look at the growth in revenue per share over the past decade, going from $5 to in 2024 above $17.71. Same is true with free cash flow per share and earnings per share. So the question is, why is this the case? And will this continue moving forward? Well, the reality is that Visa has a moat because of network effects. Visa's moat compounds because merchants accept Visa because consumers use it, and consumers use Visa because merchants accept it. It's difficult to replicate this two-sided network. Visa's continuing to benefit from more digital payments and e-commerce growth and cross-border travel and spending. And because the company is so capital light and has great reinvestment opportunities, return on invested capital, although it was already quite good, has continued to increase in the last couple of years, and in 2024 was sitting at 28.65%. That's a sign of a high-quality stock. And while we won't go in-depth to stablecoins in this video, I think Visa and both MasterCard are very well positioned to actually benefit from this potential shift. And if we just look at Visa from a PE sensitivity model valuation perspective, what we can see is even if the PE multiple pulls back to its historic averages, maybe closer to even around 30, if they achieve that around 11% earnings growth moving forward, forward-looking returns still look quite attractive. Lastly, we have Walt Disney Company, a company that has destroyed a lot of shareholder value in the last decade. In fact, if you bought Disney stock around 10 years ago, your total return would have been 5%, which means inflation adjusted, you would have actually had negative returns. There's not many large cap stocks that have done this poorly. So what's Barron's case? What's their bull case for picking this stock in 2026? Well, while Netflix and Paramount Skydance are prepared to pay a stiff price for Warner movies, TV and streaming businesses, Disney shares are falling behind despite controlling some of what they call the industry's best assets. Disney stock was hit after its September quarter results due to a disappointing experiences segment which is dominated by Disney World and other parks. The profit outlook, however, looks better, with Disney projecting double-digit earnings growth in the 2026 and 2027 fiscal years, helped by cruise ship expansion. So when we look at Disney from 2019 to 2024, earnings actually fell substantially, which obviously caused them to trade at a much lower PE multiple. And in fact, during this time period, they actually slashed their dividend payment. So 2020 especially was just a disaster for Disney stock. As of right now, in the last year, they're only up by about 1%. Now, like they said, earnings estimates moving forward in the next 2 to 3 years actually look decent at around 11%. Which, when you get a stock growing earnings at a double-digit rate that's simultaneously trading at a valuation multiple of only around 16 to 17, from a price-to-earnings growth perspective, the stock starts to look more attractive. And that's likely why Barron's picked the stock, and it's probably the reason that Wall Street analysts are becoming more bullish on the stock, giving it about 22.5% upside over the next year. So is there opportunity with Disney? I think that could certainly be the case, but you also have to be careful with a stock that has been mismanaged so much in the last decade and destroyed so much shareholder value. One of the top things Warren Buffett looks for is competent management. And if that's something that's important to you, then Disney stock might not be for you. They certainly haven't proven themselves over the last 5 to 10 years and have even divided a lot of their audience politically speaking. So there you go. That is Barron's top 10 stocks list for 2026, and I think we saw a clear trend for the majority of the stocks on this list. They weren't picking stocks that had been winners in the recent years. In fact, for the most part, they picked a lot of deep value stocks, such as Bristol Myers Squibb, Comcast, Madison Square Garden Sports, SL Green Realty. These are companies that get very little coverage. So in my opinion, this is actually a pretty aggressive list, and I'll be interested to see how this list plays out over the next year. Again, if you want to get access to any of the sheets used to analyze these stocks and access to the ticker data add-on on Google Sheets, then go over to tickerdata.com and use code 2026 to get 30% off the annual plans. Take advantage of the New Year sale. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.